Okay, thank you. We have a tough job coming directly after lunch, so I think Luz and Bill did a great job. I'll just paraphrase what they say and we can go home, which is it's liquid and buy over 500. I think that we'll just leave it at that. If we can go to the next slide, I think there are actually some details we'll probably have to get into, so we'll do that. By the way, the table for what we're actually talking about, and then we'll go into our outlook. So again, as Chris mentioned, our team here manages the investments in U.S. corporate credit. That includes investment grade corporate credit, high yield, and bank loans. It's a diverse across these. The diversity we get across all these asset classes lets us manage the key risks that you have in fixed income, which is duration and credit risk. In the case of duration, we have three different asset classes that have very different characteristics. Investment grade is long duration, about 7 years. It's non-prepayable, so it has the most interest rate risk. High yield is in between. It's about 4 years of duration. It is callable, so it has some prepayment optionality in it. So it's medium duration. And then bank loans are floating rates. So the duration is basically zero. So that gives you the least amount of interest rate risk. And obviously for 2022, with rising inflation and rising rates. Okay, all right. I guess I have a hot mic. Is it better? Okay. With inflation last year and the risk of rising rates, it was very important to make the right duration call. So investment grade suffered the worst losses last year because they had the longest duration. Floating rate, bank loans that, like I said, have duration nearly zero, were down on less than 1%, while high yield was down 10% and investment grade was down 15%. So it was really more important last year to think about rate risk than credit risk because the economy was generally in good shape and the economic slowdown didn't really put pressure on credit risk. This year, I think you have to think about that. So the other attribute of corporate credit is that you can pick how much credit risk you want. Investment grade is the strongest credit quality. You know, big names like Microsoft, Apple, Verizon. These are, some would argue, stronger credits than the U.S. government itself. I guess we'll let other panels debate that, but they're extremely strong, can handle any sort of economic volatility. They have very defendable business models, very strong balance sheets. But of course, with that strength comes lower yields. So if you want safety, then you get a little bit less yield than high yield or bank loans. If you want, if you're seeking a higher yield and you're willing to accept a little bit greater volatility, bank loans and high yield give you that additional yield for the additional credit risk. I think do I control the slide here? There we go. Two other characteristics. Liquidity is important. People refer to corporate credit often as the liquid credit markets. We're not as liquid as treasuries or agency mortgages or anything like that. We are more liquid than most parts of the credit market. In periods where you have flows, liquidity is important. At DoubleLine, as a multi-sector asset allocation firm, liquidity is very useful when your outlook changes so that you can rotate out of the less favorable parts of the market into more favorable. So liquidity is your friend, particularly in a market like this. Also, a key attribute of corporate credit broadly is diversity. It's not one thematic sector play. It's across the entire U.S. and developed economies. That lets you pick your spots. So in 2023, we're worried about an economic slowdown. We're worried about inflation. We can underweight sectors that we think are going to perform poorly. Maybe we think the consumer is going to be under pressure, so we can underweight consumer-related credits. We can underweight restaurants, retail, things that are directly exposed. Housing, if housing were about housing and building products, we can underweight that. And we can go into sectors that we think might actually be a beneficiary of inflationary pressures. Commodities, so the energy space. Energy producers are a beneficiary of commodity price inflation. So that's a clear place where you can actually allocate and take advantage of inflation. There are other sectors too, grocery stores, distribution facilities. They actually are able to capture inflationary gains. And so the point is, you have to set your outlook for the economy, and the diversification allows us to pick the parts of the U.S. and domestic and diverse and developed market where we think that there's the best opportunity for performance. Now we're going to dive into, okay, well, now what do we do? Now we've talked about what it is, what do we do? I'm going to go through briefly the three asset classes. I think you have to understand the health of each of these asset classes to understand what to do when the opportunities present themselves. As we were putting this presentation together over the last week or so, we were looking at a ferocious rally in credit spreads and in equities. So the market coming into coming after New Year's became really excited about peak inflation, a Fed pivot, a soft landing, and the markets roared. And given those trade locations of the S&P, high yield, investment grade spreads in bank loans, it was starting to get to the point where maybe the opportunity had passed itself. But what has worked over the last 12 months is to trade the volatility in hot periods like we just saw. Maybe it's time to trim some risk. And then when spreads widen, there's an opportunity to maybe put some more risk on. We'll talk about that in a minute. But broadly, spreads got pretty tight over the last couple of weeks. Now they're backing up. High yield, I know, is wider today. So we might have an opportunity yet again. If we talk about just the outlook from the economy as a whole, I think it's optimistic to say we might have a soft landing. Now that's optimistic. Maybe a more sober outlook is that we have a mild recession or maybe like a real recession. But let's just talk about what a soft landing might look like. A soft landing really means anemic growth. In a period of anemic growth, there's going to be winners and losers. Some companies are going to do well. Some are not going to be able to do so well. They're going to feel the continued pressure of this kind of anemic, slow growth environment with likely persistent inflation. What a soft landing does not mean is a resumption of robust economic growth. If you're going to be really bullish about the stock market, if you're going to be really bullish about credit spreads, and you kind of just buy without regard, it's because you think that we're on the precipice of some kind of resumption of robust economic growth. That's when spreads really collapse and you make a lot of money, really not having to worry about your entry point and credit selection. I'm arguing we're not in that environment. We're in an environment where the soft landing is the best case scenario. It's going to mean that there's going to be winners and losers. Credit selection is very important, and your entry price is very important. You have to buy at the right time, and you have to buy the right names. So in this environment, security selection is key. I'm going to touch on all three of the asset classes we manage, and then we're going to go into a little bit more depth for each of them to get a sense of the health of each of these asset classes and where the opportunities and pitfalls are. First, with high yield. High yield is usually the canary in the coal mine. Usually, we get into this period of economic weakness, and high yield falls apart, and it's the aha, look at high yield. It's the warning sign, we better pay attention. Well, that's we're not seeing that now. I would argue that high yield is in the best quality that it's been for over a decade. We'll get into that in more detail, but it's the highest rated. The energy issue, which was a problem starting in 2015. There was rolling defaults as oil prices collapsed in 2015, caused this wave of defaults, really from 2015 to 2020. And other stresses basically took a lot of risk out of high yield. Those risks went to the bank loan market. So high yield, I would argue, is the highest quality it's been over the last 10 years since the financial crisis. Bank loans, I would argue, are the worst credit quality that they've been over the last 10 years. The general idea that bank loans are safer than high yield does not work anymore. And we can get into some of the details for why that's the case. Simple reason is, for a while, people knew that rates were rising, and the demand for floating rate assets in general, bank loans, CLOs, other floating rate assets, were the solution for the likelihood for a rising rate environment. That worked really well in 2022. The best performing part of the corporate credit market was the floating rate bank loan space, down less than 1%. But that inflow from investor activity into the bank loan and other asset classes, while it worked from a rate perspective, built up risks. When you have large inflows into an asset class, that's when you have overinvestment in particular sectors. That's when mistakes happen. And those are sow the seeds for problems down the road. And I think we're getting closer to the end of that road where we'll start to see the problems that were created because we had this overinvestment in bank loans. And then last, investment grade. Monica is going to speak about it. Just from the high level. In my 10 years at DoubleLine, we've thought that investment grade has been relatively unattractive because the yield per unit of duration was terrible. Fed, after the financial crisis, brought rates down to zero. The yield on investment grade credit went sub 2 at the lows with a duration of 7. That means a 1% increase in interest rates wiped out all of many years of carry that you get in that asset class. Fast forward to today, with higher yields and higher spreads, that ratio is a lot more attractive. And for the first time in really 10 years, I think there's some exciting things to do in investment grade credit. I'm going to leave that to Monica for a little bit later. So we're going to move on to high yield. Like I said, high yield usually is the early warning signal. There are many things you can look at to measure the quality of the index. Ratings are a pretty simple way to look at it. So high yield used to be a single B predominant asset class. Now it's double B. The double B rating category was under 40% of the high yield index. Now it's over 50%. So from just a pure credit quality perspective, it's improved a lot. Why is it so much better? Part of it's the fallen angels of 2020. Some companies were downgraded from investment grade to below investment grade, Occidental Petroleum, Ford. You also have some very strong rising stars like Netflix, household names, Sprint, which merged with T-Mobile. These are rising credits that will be investment grade someday and are much higher credit quality than the traditional double B. Overall, we have this just much better credit quality. This is leverage. So a fundamental metric for measuring corporate credit is leverage. So total debt to EBITDA. You can see, it's a lot of numbers here, so maybe I'll just tell you. You can see a spike. So the spike was coincident with the pandemic. Leverage was moderate in 2019, and then we shut down the US economy. Companies had no earnings, and their leverage spiked. The worst cases were the leisure and transportation sector. The airlines borrowed against every asset they could get to delay and to build more liquidity to kind of survive through the scenario. Cruise lines had zero revenue, so they did new issue secured against their boats to basically provide liquidity to survive until the point we're at now where the economy is reopening. So this huge spike up in leverage. Well, the economy started to open. These companies started to generate earnings again. The companies that weren't shut down were able to grow, get back to kind of more kind of recovery kind of growth rates, and then leverage came down. So now leverage sits below 4 times. A typical high yield investor thinks of high yield as a loan to value proposition. You typically want at least or no more than 60% loan to value. And we can get in arguments about valuation and interest rates, and I think people could make an argument that multiples, companies are worth 10, 12, 13 times EBITDA, whatever number you want to use. If I go old school before the pandemic or before rates went to zero, 8 to 10 times EBITDA is a pretty conservative multiple on a regular high yield issuer. There's some that are higher, some that are lower, but let's just take averages. At 8 times EBITDA, we're 50% loan to value in high yield. Again, I think the point is we are not in the danger zone. If anything, we're at some of the safest places we've been in quite a long time. Some people like to do the bad stuff. At DoubleLine, we don't love it, but it's on the slide here. So the X leverage, gaming and transportation, the sectors that were most damaged by the pandemic. If you take those out, leverage is even lower, but I tend to want to ignore that. I think you don't have to do the bad stuff, even including the bad stuff. Leverage is very moderate. And so we're not set up for some kind of implosion of leverage and defaults. Another important stat is interest coverage. This is the interest burden over EBITDA, and it's at a record high since 2013, so for the last 10 years. This is going to come down. Obviously, rates are higher. High yield borrowers are going to have to refi when their bonds are due, and they're going to have to pay a higher coupon. But at least we're starting at a very high level. If we were starting at the lowest coverage and then you had interest rates rise, you'd have a big problem. I think that's more of a bank loan problem. But for high yield, most borrowers have kind of insanely low coupons. I mean, we were printing 3% coupons for some of the strongest borrowers. On average, it was about 4%. And even triple Cs, the lowest credit quality, there are many borrowers who have middle 5 to maybe 6% coupons, which is kind of insane when you think about T-bills at 5% now. Think about triple C borrowers with 6% coupons. So they have very cheap sources of financing. They're not going to prepay those. They're going to leave them standing as long as they can. And then at the very last minute, they're going to refinance it at was presumably higher rates. But at least we're starting with some cushion. This is a messy slide, but it's basically the same point that this is earnings growth. Earnings collapsed during the pandemic. It went from somewhat positive to very negative. The economy opened up again, and then earnings growth was something like 80%. We reflated everything. Now we're looking backwards. I think this is third quarter of last year. We were running at maybe 15% EBITDA growth. This is decelerating. You can look at the slope. We're seeing a decrease every quarter. The fourth quarter numbers, when they come in, are going to be lower than the third quarters. And if you use the S&P as a guide, S&P estimates for 2023 slightly negative. I would argue they're going to be worse than that. So high yield EBITDA probably continues to get closer to zero. If we're going to have at best a soft landing, then we probably have at best around zero earnings growth, which is okay for most borrowers, but not for all borrowers. But since the credit quality in high yield is what I'm suggesting, then I think we'll find a way to make it through. So this is a slide on spreads. What has been a great strategy for managing high yield for the last 12 months is to sell high yield when it gets to 400 and below and buy it when it gets close to 600. And we've had this volatility for the last 12 months. It's continuing now. So spreads were very wide in September, October. Somehow everyone had their New Year's party and started buying everything, and spreads went sub 400. We thought at DoubleLine that was a great time to sell. So what were we doing when spreads went below 400? We were selling high yield credit. Now today we were 440 yesterday. We'll probably be mid 400s. We might even be close to 500 again by the end of the week. So the euphoria of January, February is sort of falling off, and now I think the market is sobering up to the reality that maybe we're not going to have a resumption of strong economic growth. And then the other side here is yield. Yields 8%, will probably be 9% soon by the end of the week. That's a lot of yield. Now, I know many people are just simply look at high yield and say, it's 9%, what could go wrong? That is a tremendous amount of yield. You've never been able to get 9% in high yield, or not never, but over the last 10 years, you've been unable to do it, so let's just buy. You have to pay attention to spreads. With treasury rates where they are, you have to look at what you're making on top of treasuries. You can't just say 8-9% is fine. And you also have to think about what sort of volatility you have if the economy weakens. So I think those are two important components. This is a terrible slide for a presentation. I get that. So I'm going to skip one of them and go to this one. I just make a couple points, and then you can look at it after, or we can talk about it after. There's blue bars that are break evens. And so if spreads move out 100 basis points and the default rate goes to 7%, which I don't think will happen this year, that's your break even. If you go all the way to the bottom right, the darkest red spot, that's spreads going out to 750 basis points over and a default rate of 10. A 10% default rate is not a mild recession. That is a regular recession. In that case, you're down about 8% or so. And then the point is, if you go back to 400 spreads with light defaults, you're going to be 10, 11%, maybe even 12, depending on how tight spreads go and how low defaults go. So we have some positive asymmetry here, where the downside, now that we've had some spread widening and we have higher rates to start with, those higher rates absorb defaults. And so the likelihood of high yield being down 30% or something kind of terrible It's really not likely unless the economic outlook is much, much worse than anyone's predicting. More likely, your downside's probably on the order of 10% or so in a more of a kind of regular way slowdown. And then you have the upside if things recover. It really is best for high yield and for bank loans for the below investment grade side to look at a 2-year time horizon. If you're looking for a 1 year or less, you probably want to be up in quality and investment grade. The way to buy below investment grade when it gets into this kind of uncertain economic time is to buy when spreads move out with a 2-year outlook. And that generally, if you get over 500 basis points, which is where this is a scenario of a 500 basis point spread location, the high yield market has never lost money using a 2-year time horizon if starting spreads are at 500. So just like Luz was saying for EM, 500 is the magic number. It's sort of a good number to start. Now, this is at 500. If you start buying at 500 and then you really wait for the buy everything moment when you get sort of north of 750, it's kind of hard to lose money there. So if you're patient and you put some money to work when spreads are probably where they're going to wind up in the next couple of weeks, north of 500, and you leave capacity to buy when there's real volatility, that's when the risk of losing money is low and the opportunity to make a lot of money starts to increase substantially. So we're sort of on watch for something to happen. If there's a spread moment where spreads widen, I think you have to act. The reality is over the last few years, these moments of when spreads blow out, they don't last that long. The market's just too dynamic and people come in and buy it. But that's kind of some framework to think about things. Now moving on to loans. Like I said, loans are sort of instead of the best case, they're in the worst case. It used to be the case that you could say bank loans are safer than high yield. I don't know that that's necessarily true anymore. From a rating perspective, they're much lower rated. So half of high yield is double B, 62% of loans are single B. If you look underneath that, 25% using S&P, the S&P rating house, 25% of S&P, the loans in the S&P index are B minus. That's a pretty huge number. So single B, so B minuses very frequently become triple Cs. Triple Cs have a very high default rate, over 20%. So the bank loan sector with looking just at single Bs at 25% and B minus of 25% and all single Bs at 60%, it represents a risk that you have to pay attention to. This shows historical interest coverage. It looks good looking historically, but we know rates are rising. So at least, again, we're not starting at the lowest coverage, but we know this is going to be a problem. So if we go to the next slide, this is the problem. And this is beyond the ratings. You have a coupon problem. So what worked for investors in an environment where rates are rising, if you have zero duration and rates are rising, you get the benefit of that. The light bar at the bottom is the spread, and then the dark bar is the base rate. So you can see in 2021, you made most of your return off the spread because the base rate was nearly zero, LIBOR. So in this case, it's LIBOR. It's converting to SOFR, but for this analysis, it's mostly LIBOR. They're the same anyways. But so you started with a 4% coupon that a borrower had to pay on average in 2021. Now it's exploding up to almost 9%. There are borrowers that are not going to be able to service this debt. Looking at credits, particularly the single Bs, there are many credits that had roughly 10% free cash flow that now have zero and maybe even negative just because of this alone. That doesn't even include slowing earnings, which generates slowing earnings, margin pressure, cost inflation, things that are pinching them on top of rates. When you have a combination of all of that, labor issues, material supplies, all the things that people are talking about, you throw that on top of a coupon doubling, it creates a real problem, and that will generate higher defaults for bank loans. That doesn't mean it's all bad. So there are the single Bs that are going to default, and of course the triple Cs, and you need to steer clear of those. But there are high quality credits that used to have a 2% coupon that now have an 8. Now those are wonderful. Now those are mostly double Bs, some very strong B1s that a few years ago, you had a spread of 200 and a base rate of 30 basis points or so as a mid 200 yield. Now those reset to 7 or 8% for credits that have a pretty low probability of default. That's pretty interesting. So until spreads widen again in high yield, I think the trade of the day, at least in corporate credit, is these strong double Bs that have a very, very low default probability, where you can generate an 8, maybe even 9% current yield. That's very attractive. Spreads may blow out. We might have volatility. We might have recessionary indicators start to become more clear. 9% current yield compensates you for a lot of that. It's different than high yield. High yield might have a 9% yield, but the coupons are maybe 4 or 5%. So the current carry is not as high. You need those bonds to go back to par to earn that full 9% return. So I think this is pretty interesting. If we're holding this meeting in September, October of last year, I probably would have said high yield's the most interesting thing because it had blown out so much. The discounts were so great. Investment grade was interesting then because it was at this a higher spread location. Now that things have evolved, I think this for right now, bank loan, the high quality part of the bank loan market is where I think the most attractive investment today at the moment, given the high carry. So this is, again, leverage, sort of a fundamental statistic. You can't really ignore it when you're talking about corporate credit. This is declining for the reasons we talked about. Pandemic, companies' earnings collapsed, then earnings recovered. But I don't know if anyone can even see the numbers here, but the number for leverage of the bank loan market is 477. So let's round up to 5. And high yield is sub 4. It's not supposed to look like that. The leverage of the bank loan market is supposed to be less than the leverage of the high yield market. So if we want to see why bank loans maybe aren't safer than high yield, here's yet another one. You have rate risk, you have lower ratings, and you also have more leverage than the high yield market on average. So I think that means that bank loans are something you have to be careful with. Now this is spreads again. Now the market is somewhat efficient, right? So we're saying that bank loans are riskier and the spreads are higher. So this is using the Credit Suisse Leveraged Loan Index. The spread as of when we're making this slide, it'll be wider now, is 571. So the spread is much wider than high yield. High yield's at least 100 basis points tighter than bank loans. If you look at a single security and look at the difference between the senior secured high yield bond and the senior secured bank loan, we see very frequently you can get 100 basis points or even more for the exact same credit risk. It's just partly the inefficiencies of the two markets. I suppose some people would say, well, LIBOR could start to fall, and so you're not going to achieve those coupons. And that's an argument in the past that really had some merit, because often when you look at swap bank loan yields to high yield, they never sort of achieve it because rates start falling right away. Well, now we have a Fed that's committed to keeping rates higher for a longer period of time to stamp out inflation. So I think now you can actually make the case that the bank loan yield is more likely to be achieved. And it's not just some fantasy because LIBOR is going to start falling. Like I said, transitioning to SOFR, it's not going to start falling and you're never going to experience that. So today, with an index at 9.5%, there are concerns, but that is not a yield to worst. That is a current yield. So that nearly a current yield. The discount is a few points. So you're going to have a carry of nearly 9%. That is a lot to compensate you for what is, in my estimation, a more risky asset class than high yield, and of course, a lot riskier than investment grade. Again, here's the horrible slide for presentations. If you take a communications class, they would say never use a slide like this. But I think the point here is you even have more positive asymmetry in loans. If spreads move out 100 basis points and you have a 9% default rate, which again is a pretty bad default rate, that's your break even. If you go to the full, bottom right, dark red, where you have 750 basis points of spread and a 10% default rate, you're down maybe 3.5%, 4%. If we go back to a tighter 4% no default environment, you have double-digit returns. So I think the point of this is simply to say, in the past, we've had a very negatively skewed payoff profile because we had very tight spreads, we had leverage, all these credit risk, all these things are building up. Now with the greater spread And the greater base rate, the all-in coupon, it protects you against bad things happening. It protects you against the defaults. It protects you, at least compensates you for likely volatility. I'm going to skip over that. We don't have to worry about that. And then I'm going to hand it over to Monica, who's going to talk about investment grade.
Great. Thanks, Robert. And let's see if I can, is this good for the microphone down there? Let's see if I can figure out how to operate this. Great. So I think what I want to cover today, and really the two main things that I look at when I'm looking at investment grade is, number one, where are the fundamentals? Where have they come from? Where are they going? And then also, two, is where are valuations, right? Are you getting compensated for whatever the risks that are out there and what your outlook is for? So we're going to start by talking a little bit about what the fundamentals look like in the asset class, then get into a little bit more into valuation, and then kind of see what the return profile might be given all of that. And I'll take a step back. I think we at DoubleLine, and myself in particular, I've been pretty vocal about the risk in the asset class over the last couple of years. And that risk was primarily the long duration of the asset class. I think we were talking about at the beginning of last year, the asset class had one of the lowest yields that it had offered for over a decade and the longest duration. And really that is where the risk lied. The risk profile of that has now improved, and we're going to get into that. Robert mentioned that as well, where now you are getting a little bit more yield compared to where your duration risk is. So we'll get into that. But let's start by taking a look at what the fundamentals look like. In terms of ratings, that is one dynamic that we look at to see kind of where the fundamentals are. And you can see that this is a chart showing the amount of rising stars, so companies that have gone from high yield into investment grade, and then also the fallen angels, so companies that have come from investment grade and gone down into high yield. And you can see there was a big spike in 2020. March of 2020 was obviously a very difficult time. There were several credits that got downgraded, but you can see that we've really turned the corner, and there have been more companies going, and Robert mentioned this as well, companies going from high yield into investment grade, and less so going from investment grade down into high yield. The expectation for this year is for this trend to continue. JP Morgan had an estimate out. I think they were expecting something like $150 billion of upgrades this year versus something like $40 billion of downgrades. I think my estimate is a little bit more conservative when you look at the underlying credits that could get upgraded. I think the two main ones are Occidental Petroleum and Netflix, which Robert mentioned. And that's about $50 billion combined debt, along with some other smaller credits. So I think this trend in terms of rising stars is going to continue through this year. And one of the reasons for this is companies really have, especially in the investment grade space, have really been focused on their balance sheets. I think March 2020 was a huge shock to the system and to companies overall. And so the focus, and just as a side note, I'm sure you all saw today that Intel announced that they're cutting their dividends. Again, an indication that they're really concerned about their balance sheet. And so I think that this trend is going to continue. The other part of the fundamental picture, and Robert had slides to this as well, is just looking at where leverage is, where it's come from. And also, and leverage, meaning the amount of debt that companies have outstanding versus their cash flows, right? So the absolute number. But the other important component of it is their ability to finance that debt. So their ability to finance that debt has to do with how much cash flow they have versus their interest expense. And that's what I think on your side, the right-hand chart shows. So you can see that interest coverage is at all-time highs, and it's been fairly high because we've been in a very low interest rate environment. Leverage has come down from the peak in March of 2020 and is at very reasonable levels. And if you look at we did a 10-year chart because pre-GFC, I think the numbers get a little bit skewed. But if you do go back, you will see that leverage was lower then, but interest coverage was also much lower because interest rates were so much higher. So our anticipation is that companies are going to continue to focus on their balance sheets. I think they are aware of higher financing costs. So we've seen over the last 10 years, companies like Apple, Microsoft, Google come to market. They have more cash on their balance sheet than they have debt. They really did not need to come to the investment grade market, but financing costs were so incredibly low. So that is what has brought that leverage number up. And I think that we'll continue to see more discipline around the balance sheet as interest rates rise and finance costs rise. And this is part of, I should have had my glasses. I can't see that slide. I'm going to have to look over here. Part of the fundamental picture in terms of earnings, right? So for the fourth quarter of last year, which is what we've been listening to over the last 3 weeks or so in terms of earnings, earnings for the investment grade space have overall been pretty benign. The two sectors where we've seen some negative growth has been in the big tech sectors and in the banks. Both of those sectors have incredibly strong balance sheets. I've been talking about, frankly, the banks are one of our favorite sectors. They're basically regulated like utilities now. One of the reasons why bank earnings have been decreasing is because they're coming off incredibly strong comps. And they're also looking forward at what the economy might present and taking write-offs or reserves in anticipation of potential write-offs. So the earnings picture for the banks really is much more of an equity story than it is a credit story. And again, on the tech companies, the large tech companies are coming off incredibly strong earnings. And again, they're companies, like I mentioned, like Apple and Microsoft and Meta that have more cash on their balance sheet than they have debt. So they've been opportunistic in terms of financing, raising capital in the debt market, but they have plenty ability to repay that debt. So I'm really not that concerned that their earnings are down for the quarter. We don't want to be Pollyanna-ish about it. So, looking forward to 23 this year, I think that there is definitely a more skew towards downside than there is potential upside. Still, overall, earnings and revenue are expected to grow at very low levels overall, which is for the investment grades space a perfect place to be. Flat. I'll take flat growth all day long as companies are paying attention to their balance sheets. The two sectors for this year that are expected to get hit for earnings are in the energy and material space. Energy is a fairly small part of the investment grade space. The energy companies that are coming off of super tough comps are the EMPs and the integrateds. They're about 3% of our benchmark. And again, most of the integrateds, BP, Chevrons of the world, these are AA, single A credit. So again, from a credit perspective, for this year, I think earnings are going to be positive, at least from a credit perspective, while not having exceptional growth. Now we get into the valuation part of it. Like every fixed income asset class, we're seeing the highest yields that we've seen in over 10 years in the investment grade space. That is all-in yields. That is just one component of what we look at in terms of valuation. The other part is spreads. And we are, I would say, fairly valued at this point. Spreads are right around where the 10-year average is. I would say there is probably more risk in the economy right now, or perhaps more uncertainty as to where inflation goes, how effective the Fed is going to be in controlling inflation, what that does to growth. So with all of that in mind, I would say that spreads should probably be wider than the average. So to what Robert was speaking about, the way that we approach it is we really want to be tactical this year. And when spreads are out, call it 20 basis points, 30 basis points from where they are now, we would be active buyers in the space. And if they get below kind of the 10-year average, we would be interested in taking some profits. So I think throughout this year, there's going to be opportunities because I think there will be some volatility, at least on the spread component of it, and for sure in the all-in yields. And frankly, that is just as a side note, that is really where all of the volatility has been. Spreads have been fairly contained within a narrow trading band compared to what the Treasury movements have been. And as you all probably know, investment grade corporates were one of the worst asset classes last year, all related to duration and 90% related to the move in the Treasury market, not related to spread. So it's all really the volatility is coming from the Treasury market. Okay, and this was also something that Robert mentioned. When I started this talk, we were talking about how the setup going into the investment grade space prior to this year was so poor, where yields were close to all-time lows, duration was close to all-time highs. We call it the Sherman ratio here at DoubleLine. And this metric, the combination of what kind of yield you get per unit of duration, has improved from a low of 0.2 times to a current, I think we're at 0.7 times right now. So all this means is that given the higher yield, that you can withstand more movement in the overall yield and still have a positive return profile. And I think we have the next slide that will show what the potential return profile would be. And I'll give you a moment to take a look at it, but it's basically looking at the change in spread and the change in yield. And our base case is that spreads are going to be volatile throughout the year. And volatile, I mean, the volatility is all relative, right? So in the investment grade space, if spreads are out 7 basis points, that's volatility. This is not an EM credit where spreads might be out 200 basis points, or high yield credit, same kind of thing. So I think the base case is that we're going to end the year with spreads around where they are right now, with volatility in between. And I think on the long end of the Treasury market, we could see some rally if the Fed continues as we expect to raise rates, and there is an ability to control inflation, and then there's expectations for lower growth. So you could get some lower yields on treasuries at the long end, while we would still expect on the front end for treasury rates to be increasing as the Fed continues to raise rates. So the base case is that you could see the return profile for investment grade could be somewhere around what the current yield is, or the yield to worst of, call it 4.5%. Your upside is maybe 10%. And so it's probably, the return profile is probably going to fall somewhere in between those two numbers.
Okay, I think that's it. So thank you, everyone.
Thank you.